You know, when you walk down the street in a major city and you look up at a towering commercial skyscraper,
Right.
the immediate sensory experience is just, it's one of immense physical weight.
Oh, absolutely. Yeah.
You see the, you know, thousands of tons of poured concrete and the heavy steel girders, the
Mm.
sheets of architectural glass, and just the sheer permanence of it all.
It's massive.
It is. But what if I told you that the steel and the glass are actually just the physical exhaust of something entirely invisible?
Ah, I like that phrasing.
Right.
Right.
That the real force erecting our skylines isn't a fleet of construction cranes, but a massive invisible global river of abstract numbers.
Yeah.
You know, yield curves and highly complex financial strategy.
It is the hidden architecture beneath the physical
Oh,
architecture.
exactly.
We are so accustomed to viewing real estate as a hyper-local, physical asset
Okay.
that we often completely ignore the macroeconomic plumbing that makes it all possible.
We just see the building.
Exactly. But when you start to view a city skyline not as a collection of buildings, but as a physical manifestation of global capital flows, your entire perspective shifts.
And that structural shift in perspective is exactly our mission today.
This it is.
So welcome to the deep dive. For the learners joining us who want a shortcut to the kind of structural market mechanics usually reserved for institutional allocators, you know, you are in the right place.
You really are.
Today, we are exploring the foundational concepts laid out in chapters 1 and 2 of the book Capital Markets and Real Estate.
How Money and Capital Shapes the Property Market by Willem Tait.
That's the one. And as a quick reminder, there are links in the bio if you want to dive deeper into the original source material.
That's highly recommended.
Yeah, definitely. So, okay, let's unpack this. Tait-Er's core thesis relies on the inherent, almost violent friction between these two asset classes.
Yeah, the friction it's born from a fundamental structural mismatch.
Okay, how so?
Well, the capital markets, equities, bonds, derivatives, they demand velocity. They are highly dynamic, entirely abstract, and above all, they are hyperliquid.
Meaning things move fast.
Incredibly fast, like trillions of dollars
Yeah.
shift across borders in milliseconds based on, a central bank whisper or a fractional change in an inflation report.
Just boom. Instantly.
Exactly. But real estate is the exact opposite.
Right, it's concrete.
Literally. It is the most illiquid major asset class on the planet. It is geographically anchored, it's politically constrained by local zoning, and it is painfully slow to transact.
So it's this unstoppable force meeting an immovable object.
Basically, yes. Yet despite that absolute mismatch in velocity, they're entirely dependent on one another.
Okay, so break that down for me. Why do they need each other so badly?
Well, the capital markets need the physical mass of real estate as a stabilizing anchor.
Yep.
And real estate needs the capital markets because building skyscrapers is incredibly capital intensive.
You can't just put that on a credit card.
No, you really can't. Let's look at how that plays out with institutional allocators,
Okay.
like a massive state pension fund. Right. A pension fund has a 30-year liability. They are mathematically obligated to pay out retirement income to teachers or firefighters decades into the future.
Right, so they need something safe.
Exactly. To meet those long-term liabilities, the pension fund needs an asset that provides durable inflation hedging yield.
They can't just throw it all into tech stocks.
No, they cannot aggressively allocate the entirety of a firefighter's retirement fund into high-beta tech equities. They'd lose their minds.
Yeah, that would be bad.
So they need the steady contractual cash flow that comes from commercial leases.
Okay, so real estate acts as like a vital inflation hedge because as consumer prices rise, commercial rents generally rise in tandem, right?
Exactly. It protects the real yield of the portfolio.
Okay, but wait, I have to push back heavily on this idea of real estate acting as the ultimate safe haven for the capital markets.
Oh, I know where you're going with this.
Yeah, because Tait positions physical property as a comforting anchor in times of macroeconomic turbulence. But if we look back at 2008, it wasn't a safe haven at all.
No, it was the epicenter.
Right. The hyper-financialization of real estate through mortgage-backed securities literally blew up the global economy.
Yeah.
The capital markets took a physical asset, chopped it up into synthetic derivatives, and engineered a systemic collapse.
They did.
So how do we square that reality with the safe haven thesis?
That is the crucial counterpoint. And it gets to the very heart of what happens when the financial derivative completely detaches from the underlying physical reality.
Which is exactly what happened.
Exactly. In 2008, the capital markets essentially forgot what they were trading.
They were just looking at numbers.
Right. They weren't analyzing the underlying physical asset like the actual single-family home in Nevada or the borrower's actual ability to pay.
No, they were looking exclusively at the synthetic tranches.
Exactly. They bundled subprime mortgages, sliced them into tranches based on assumed statistical risk, and relied on AAA ratings that masked the underlying rot.
And the rating agencies treated those senior tranches as if they were as pristine as U.S. Treasuries.
It was wild.
It's insane. They entirely ignored the fact that the underlying cash flow depended on borrowers who were highly vulnerable to a reset on an adjustable rate mortgage.
Right.
So the capital markets turned an illiquid local asset into a highly liquid, globally traded derivative.
And in doing so, they stripped away the friction that usually keeps real estate markets in check.
The friction is the safety.
Yes. The feedback loop broke. When you hyper-liquefy an asset through opaque derivatives, you introduce severe moral hazard.
Right, because the originator of the mortgage no longer held the risk on their balance sheet.
Exactly, so they dropped their underwriting standards to the floor.
Anybody could get a loan.
Anybody. So the 2008 crisis wasn't a failure of real estate as a physical asset.
Okay.
It was a failure of the capital markets mispricing the derivative of that asset.
I see.
But it proves your point perfectly. When the abstract financial strategy misaligns with the physical reality of the real estate, the fallout is catastrophic.
Which brings us to the incredible strategic coordination required to keep this global machine functioning today.
It's a massive balancing act.
Because you have local developers whose daily concerns are entirely physical and bureaucratic.
Right.
You know, navigating municipal zoning laws, managing supply chain bottlenecks for steel, and projecting local tenant demand.
Very grounded things.
Yeah, very tangible. But to fund their vision, they have to align with capital market professionals sitting in Tokyo or London who are modeling sovereign debt yields and currency risks and macroeconomic trend lines.
The developer in Brazil and the institutional allocator in Japan are speaking entirely different professional languages.
It's like they're not even in the same universe.
Yeah, they're not.
Yeah.
The developer is modeling cap rates, rental yields, and construction draw schedules.
Yeah.
The allocator is analyzing duration risk, credit spreads, and portfolio diversification.
So how do they even communicate?
Well, to bridge that gap, the financial plumbing has to be perfectly calibrated. The capital from that Japanese institution has to be structured into a vehicle that matches the risk profile they require while providing the localized developer with the massive upfront capital injection they need to actually break ground.
Okay, I see. And we are also seeing the capital markets exerting a powerful remote control influence over the actual physical engineering of these buildings.
Oh, absolutely.
Particularly through the lens of ESG, so environmental, social, and governance mandates.
This is a huge shift.
Yeah, this is no longer just a public relations bullet point for developers. It is a hard, impassable gate for global capital.
It really is.
Yeah.
Sovereign wealth funds and mega asset managers now have strict, legally binding ESG mandates from their own stakeholders.
They literally can't invest if it doesn't meet the criteria.
Exactly. They are mathematically restricted from deploying capital into projects that do not meet rigorous carbon neutrality or sustainability targets.
Wow.
So if a developer is trying to syndicate $1 billion commercial project, and their architectural blueprints do not meet LEED Platinum or BREEAM standards, they simply will not get funded.
The industry refers to this as the brown discount, right?
Yeah, the brown discount.
Like if your building is older and environmentally inefficient, capital allocators will demand a massive discount to take on the asset, assuming they will even touch it at all.
Right. They just avoid it.
Conversely, we are seeing a green premium where highly sustainable assets command tighter cap rates and lower costs of capital.
It pays to be green now.
Literally. So the abstract demands of a European pension fund are literally dictating the HVAC systems, the glazing on the windows, and the ecological footprint of a skyscraper being built in Chicago.
It's incredible.
Yeah.
And this remote control effect is only accelerating with the integration of PropTech.
Oh, right. Property technology.
Yeah. Capital markets demand data.
They love their data.
They really do. They want real-time metrics on energy consumption, tenant utilization, and operational efficiency to feed their risk models.
So the buildings have to be smart.
Exactly. Buildings are now being engineered as massive data collection nodes just to satisfy the reporting requirements of the institutional investors holding the paper.
Okay, so we know why they need each other. But to really understand how this money moves, we have to look under the hood at the actual plumbing,
Let's a bit.
which seamlessly transitions us into the actual mechanical plumbing that makes all this capital flow possible, which Tait unpacks in the second chapter of the text.
Chapter 2 is where the rubber meets the road.
Right. So to really understand how global wealth shapes local skylines, we have to look at the foundational instruments of the capital markets, starting with the debt side of the equation.
Everyone always forgets the debt.
Right. We often focus on the glamorous equity side of real estate, but the bedrock of the built environment is the bond market.
It is the absolute foundation. Without the fixed income markets, modern urban development halts entirely.
Just stops.
It just completely stops. And the influence starts long before a private developer even acquires a parcel of land.
What do you mean?
Well, consider the municipal bond market.
Okay.
Cities issue municipal bonds to fund the foundational infrastructure. The transit hubs, the water treatment facilities, the public school districts.
Right, the things that make a city a city.
Exactly. And they do this because they are usually relatively low risk and tax-efficient ways to raise capital.
Right. And if a municipality is facing a credit downgrade because of local economic headwinds, their bond yields immediately spike.
They do.
The cost of borrowing for that city skyrockets, which means the planned expansion of the light rail system gets scrapped.
It's too expensive to build.
Right. And suddenly, a developer's massive mixed-use project, which relied on that transit connectivity to justify its commercial rents, is stranded.
Yes.
So the municipal bond market essentially dictates local zoning and development viability from afar.
It's a huge invisible hand.
Why?
And on the private side, you have developers utilizing corporate bonds and complex layers of mezzanine debt to optimize their capital stack.
Because real estate is fundamentally a game of leverage.
Oh, 100%.
Yeah.
By tapping into the bond market, a developer can secure a predictable fixed-rate stream of debt financing.
Which is what they need.
Right. This allows them to amplify their return on equity. As long as the yield they generate from the physical property exceeds the interest rate they are paying on the bonds, the model works.
But that leverage is a double-edged sword, isn't it?
Oh, definitely.
Because when central banks enter a tightening cycle and dramatically raise interest rates, the entire math of real estate development fractures.
It breaks overnight.
Right. The cost of issuing new corporate bonds or refinancing existing debt just spikes.
Yeah.
If a developer's debt service costs suddenly exceed their rental yields, you see negative leverage.
And that is when things get scary.
Right. That is when cranes stop moving projects, stall mid-construction, and the physical development cycle just freezes.
Which is exactly why capital market professionals obsess over yield curves and central bank policy.
It's life or death for them.
It really is. The cost of debt dictates the velocity of physical construction. But moving across the capital stack from debt to ownership, we enter the equities market.
Okay, the fun stuff.
Right. And in real estate, the most transformative equity instrument of the last century has been the Real Estate Investment Trust, or the REIT.
I love talking about REITs because they solve the primary structural mismatch we discussed earlier, which is the illiquidity of real estate.
They are a brilliant invention.
Right. Historically, if an institutional investor wanted exposure to a Class A shopping mall or a portfolio of data centers, they had to deploy hundreds of millions of dollars to buy the physical assets outright.
And then they were stuck with them.
Exactly. Their capital was locked up in concrete for a decade. But with a REIT, a company owns and operates the real estate but issues publicly traded shares.
It changes everything. The REIT structure takes the underlying illiquid asset and wraps it in a highly liquid financial derivative.
So you can just buy and sell it like a normal stock.
Exactly. It allows both massive sovereign wealth funds and regular retail investors to gain fractional exposure to the income generated by the real estate.
It really democratizes the investment.
It does, while still retaining the ability to liquidate their position on a public exchange in a matter of seconds.
But wait, here's where it gets really interesting, because this liquidity introduces a massive behavioral quirk.
Oh, yes, it does.
Specifically regarding how we value these assets. Because a REIT is not a perfect one-to-one proxy for the physical buildings it holds.
Not at all.
Because REIT shares trade on public equities exchanges, their prices are driven by forward-looking, highly volatile public market sentiment.
They trade on emotion, basically.
Right. So the actual physical buildings in the REIT's portfolio, the net asset value, or NAV, might remain incredibly stable.
Right.
The buildings are fully leased, and the corporate tenants are still paying their rent on time.
The cash is still flowing.
Exactly. Yet, if macroeconomic fears regarding a potential recession spook the broader equities market, that REIT stock price will plummet.
Just fall off a cliff.
Right. It will begin trading at a massive discount to its net asset value. So the public market is effectively signaling that it believes the physical buildings are worth 20 or 30% less than what a private physical appraiser would value them at that exact moment.
And what's fascinating here is this highlights the dual nature of price discovery.
How so?
Well, the public secondary markets act as a real-time hypersensitive health gauge. They aggregate millions of data points, interest rate expectations, and shifting global sentiment instantly.
It's all priced in immediately.
Exactly. Private real estate appraisals, by their very nature, are backward-looking.
Because they're looking at past sales.
Right. They rely on comparable physical sales from 3, 6, or 9 months ago.
So they're always lagging behind.
Always. Which is exactly why institutional players watch the secondary market so closely. When the economic cycle begins to turn, the public REIT markets signal the pain long before the private valuations adjust.
So it's like an early warning system.
Exactly. The secondary market acts as a canary in the coal mine. If you see the share prices of commercial office REITs consistently dropping on the secondary exchange, it gives you a highly accurate, real-time pulse on the degrading demand for physical office space.
Even if the leases haven't expired yet.
Exactly months before a single lease is actually defaulted on.
Wow. And the secondary market also acts as a critical pressure release valve.
It does.
Let's use the commercial office sector as an example, since we were just talking about it. If an institutional investor sours on the future of physical office space due to, say, the rise of remote work, they don't have to endure a grueling 2-year process of marketing, inspecting, and selling a physical high-rise in Manhattan.
No, they don't have time for that.
Right. They can dump their entire position in an office REIT in milliseconds. They release the pressure instantly.
It's incredible. And this massive pool of liquidity is the engine of efficiency for the entire global system. It attracts a much broader, deeper pool of capital from risk-averse investors who would never touch direct physical real estate, precisely because they are terrified of having their capital trapped in an illiquid asset during a downturn.
Right. They need to know they can get out.
Exactly. So by engineering liquidity out of illiquidity, the capital markets dramatically lower the cost of capital for the real estate industry as a whole.
Which brings us to the continuous feedback loop between economic cycles, investor psychology, and physical development.
It is an endless cycle.
Right. When the macroeconomy is expanding and central banks are keeping interest rates low, capital is cheap.
Everyone is borrowing.
Right. This cheap debt fuels a massive wave of speculation and borrowing by developers. Yield spreads widen, making development highly profitable.
Will be built.
Right. The capital markets pump liquidity into the system, and the physical result is a boom in construction.
But the truly fascinating dynamic occurs when the economic cycle inevitably contracts.
Because it always does.
It always does. During a severe economic downturn, high beta equities crash. Corporate earnings falter.
Things get ugly.
Very ugly. So in response, those massive institutional investors, the pension funds, the sovereign wealth managers, they have to act defensively.
They execute a flight to safety.
Exactly. They pull their capital out of volatile, high-risk sectors and aggressively reallocate it back into the perceived safety of tangible yielding assets.
So they run back to high-quality real estate.
They do.
So paradoxically, even when the broader economy is struggling, the capital markets can actually funnel a massive wave of defensive liquidity into real estate instruments,
Right.
which provides a floor that helps stabilize the property market from total collapse.
That's amazing.
So the capital markets cause the turbulence, but they also provide the parachute.
Provided the market mechanisms and price discovery are functioning correctly, yes. It is a self-balancing ecosystem.
Right, if everything works the way it's supposed to.
Yeah. The integration of these two realms demands that professionals in both spaces master this interconnected plumbing.
You can't just know one side.
No. A real estate developer who only understands physical construction but doesn't understand how credit spreads and municipal bond yields affect their capital stack, well, they will eventually be wiped out by a macro cycle they didn't see coming.
Just blindsided.
Exactly.
And conversely, a capital market allocator who models synthetic derivatives on a spreadsheet without understanding the physical realities of the underlying asset.
Right.
The local zoning constraints, the construction timelines, the tangible friction of the real world.
They will end up repeating the mistakes of 2008.
Exactly. The abstract and the tangible are permanently bound together.
They are. Mastering these foundational pillars, understanding how bonds dictate viability, how equities and REITs offer liquid ownership, and how secondary markets provide vital real-time price discovery. This is what allows elite allocators to mitigate systemic risk
Right.
and identify arbitrage opportunities when the public and private markets diverge.
So what does this all mean? It means it is an incredibly intricate, sometimes precarious partnership. It's a delicate dance.
It really is, and we have really only just scratched the surface of the plumbing with these foundational concepts.
We really have.
But we're going to pause our analysis here for today. We are looking forward to more deep dives, and we'll be covering the rest of the chapters of Willem Tait's book at future dates.
Lots more to cover.
Oh, absolutely. There is so much more to unpack regarding the granular mechanics of mezzanine debt structuring international capital flows and the specific ways global trends continue to reshape our local neighborhoods.
The mechanics only get more complex from here. But before we wrap up today, I want to leave our listeners with a question that builds on everything we've just unpacked.
Okay, let's hear it.
It's regarding liquidity and the concept of a safe haven.
Right.
We've established that physical real estate is fundamentally valued as a stable anchor
Right.
precisely because it is physical, highly local, and intensely illiquid.
That friction creates stability.
Exactly.
The inability to panic sell a skyscraper in 5 seconds is a feature, not a bug, when it comes to long-term valuation stability. Right. But if the capital markets through REITs synthetics and eventually things like tokenization,
Oh, right.
if they continue to relentlessly engineer financial tools that succeed in making real estate completely liquid, entirely abstract, and globally tradable in milliseconds,
Okay.
does physical property eventually lose its defining characteristic?
Oh, wow.
Like if you use financial engineering to completely strip away the friction of real estate, do you inevitably strip away the very stability that made it a safe haven in the first place?
So if we turn the concrete completely into frictionless data, does it just become as wildly volatile as a microcap tech stock?
Exactly.
That is a brilliant and honestly slightly terrifying structural thought to end on.
It's something to think about.
It really is. Thank you to our learner for joining this deep dive. Keep questioning the unseen structures around you, both physical and financial, and we will see you on the next one.